I made a comment in my last video about how industrial real estate should scare new investors, and I got a bit of flack for it. One email in particular, from another guy named Chad, of course. Why does it always need to be a Chad? He said that I should be talking about the benefits of industrial real estate instead of trying to scare people away from it. It's a fair criticism. However, I wouldn't have set up this channel if I wasn't unwaveringly passionate about this industry. I simply feel that to have full transparency on this topic requires talking about both the good and the bad. So sorry in advance, Chad, but I've got another cautionary story to tell. This one is about an investor who owns industrial properties in several different markets. Roughly 4 years ago, he purchased a building that was leased to a large construction company. The property is in a small market and it is old and somewhat run down. And because it's old, there are low ceiling heights, the spacing between the columns is more narrow than modern buildings, and it's got tight loading access to get big tractor trailers into the building. That doesn't even include all the other issues, such as poor insulation, old lighting, cracked concrete floors, and so on. Notwithstanding all of these limitations, the tenant though had been there for over 10 years, and at the time they just recently renewed their lease for another 5-year term. In short, the investor was attracted to the existing rental income, which looked really good when combined with the low interest rate he secured. The investor bought the building at roughly an 8 cap, and since they had been there for over 10 years, he just hoped that they'd continue renewing their lease. You might be able to see where this is already heading. 2 years after he bought it, the tenant informed them that they would no longer have use for the building and they'd be vacating it. They had contractual obligations to continue paying rent, so fortunately for the investor, they've been continuing to pay rent on the vacant building. To try mitigating their expenses, the company has been actively trying to sublease the property over the past 2 years as well. But because it's an older property located in a small market, they have struggled to attract any interest at all. To make matters worse, rental rates have dropped significantly since he bought it. While the tenant is contractually obligated to pay rent at $9 per square foot, he now estimates the market to be in the $6 per square foot vicinity. And the lease is about to expire. So at 20,000 square feet, the quick math on this, using the same cap rate as when he bought it, shows the building is now worth $1.5 million. He bought it for $2.25 million, meaning the property has dropped in value by $750,000. Now, of course, that loss will not be crystallized until he sells, but he'll soon have a property that'll not be receiving any income whatsoever, and the prospects of releasing it could mean a dramatic reduction in revenue. And since it's a building in a small market, it could take months, if not years, to find a new tenant or a buyer. In the meantime, he's responsible for mortgage payments, property taxes, utilities, and general upkeep. He also said that a condition of his insurance is to check on the property every 2 days. So either he'll have to pay someone to do that, or he'll have to drive an hour each way to do it himself. So yeah, industrial real estate should scare new investors. It's examples like this and the one I personally experienced, which keeps reinforcing a powerful lesson. Always ensure you evaluate what the property will be worth if it were vacant. Had this investor went through the exercise of analyzing what would happen to the property should the tenant leave, he would have undoubtedly realized it could be a challenge to release it. This particular investor owns a number of other properties, and he can afford to carry this particular property as long as necessary. Sure, it hurts, but he simply took a calculated risk and it didn't pay off. But maybe in time the economy will recover and he'll be able to make a better play out of this. But how would this play out for the first-time investor that didn't have the financial capacity to carry it indefinitely? To be fair, this is a one-off example, and I have plenty of other examples where investors have done exceedingly well, including owning properties in small markets. There's a lot of potential upside by investing in industrial real estate, but the key point I'm trying to make is that investors can't just focus on all the positives. The investor I've been referring to was attracted to the building that had a good cap rate and a tenant with a strong covenant who had been there for a while. Unfortunately for him, he didn't account for the things that could go wrong. That's why I'm a big believer in investors protecting their downside risk when considering an opportunity. And accomplishing that means that investors need to have a thorough understanding of all the various attributes of industrial real estate combined with intimate knowledge of the market. It can be an amazing asset class to invest in, provided you're smart money, not dumb money. Smart money knows exactly what they're buying, including all the pros and cons. So, contrary to Chad's suggestion that I only talk about the positives, I feel this story is important to talk about how things can also go wrong. And if you want to get a crash course in warehouse investing, check out this video right here. I'm guessing Chad is going to smash the dislike button, so if you wouldn't mind balancing that out by tapping the like button, I'd really appreciate it. And thanks for watching. Catch you in the next video. Okay, and then just hit